questions for India with me, Punita Kumar Sinha. This week, the question we are asking is, can India deepen its debt markets? There has been much talk about the need for diversification in the Indian financial markets, the primary focus being to offer investors more alternatives outside the asset class of equities. The government has in the past announced infrastructure bonds, but they have found few takers amongst global investors. So, is it time for India to open more windows for capital inflows? Is India ready for a mature debt market? What does India need to do to create a more globally linked bond market? Joining me today to answer the question are Nilesh Shah, Director, Axis Direct, Jahangir Aziz, Asia Economist at JP Morgan, and Jayesh Mehta, MD and Country Treasurer, Bank of America Merrill Lynch. Jahangir, let me start my first question to you. Is it fair to say that India's domestic debt market is amongst the largest in Asia?
Sure. I mean, look, we have roughly about $700 billion of outstanding stock of debt. About 550 of that would be federal government debt, and the rest would be state government debt. And that would clearly put us, among the largest in Asia. And also in terms of other EM economies, it would really put us on the top.
Jesh, what is your view on the depth of the Indian bond market?
In terms of settlement cycles and all that, the thing is very nice. It can be best in the world, one of the best in the world. The challenge is, the biggest challenge which we have today is, if you look at the market structure per se, it's a very limited market structure. So basically we have three categories, that is bank, insurance and provident fund. Now if you really break that down, 10 banks would constitute almost 90% of banking industry. One insurance company would constitute almost 70% of insurance industry. And maybe 4 or 5 large provident fund will constitute 75% of provident fund market. So effectively, almost 75% of the market, the end users are only 16.
Nilesh, are you satisfied with the steps that have been taken over the years to improve Indian debt market?
So clearly, this market over the period has evolved significantly. It finances reasonably large percentage of fiscal deficit in the country. So we have seen the infrastructure in the debt market developed, especially in gilt to the global standards. Where we are lacking is the corporate bond market. Corporate bond market is still getting kind of restricted through various means and various limitations, partly coming from infrastructure side, partly coming from regulatory side, and partly coming from the market side.
Jahangir, how do you compare the corporate bond market in India to the other Asian economies that you cover?
I think the corporate side is, in the secondary market of the corporate bond market is pretty shallow. Corporate bond market, secondary market turnover is low. Most people who buy corporate debt hold to maturity, and we saw that in 2008 in the post-Lehman crisis that non-bank financials who did hold quite a substantial portion of the portfolio in corporate bonds found it very hard to liquidate them, and they were forced to actually liquidate their holding of equity, which of course drove down equity prices very sharply.
Nilesh, turning to you, given that the corporate bond market is not liquid, are we ready to bring in more retail participation in that segment?
So we have created a very high cost distribution model in corporate bond market for retail investors, which is not going to work out. Now the solution to that lies in using our exchange system. We have, two exchanges, National Stock Exchange and Bombay Stock Exchange, which is present in virtually every single town and village of every single town of the country. They have members and they have systems which allows seamless transfer of securities as well as cash. So can we not create a solution whereby a corporate issuer kind of auctions its securities to retail investors, and retail investors using exchange settlement, keeps on taking bits and pieces of this issuance? We can reduce significantly cost of distribution through this kind of mechanism. So we need a little bit of freshness of approach in reducing the cost of distribution in IPOs from retail investors.
Given that, Jayesh, do you think that the Indian bond market is ready for retail participation?
They have been always there. You see, when there is an opportunity, they always come. If I look at late 80s, mid 80s, because the interest rate structures were such, I myself have transacted in a HNIs or individuals buying government bonds at maybe 6.75 or 7%, because the bank deposit rates were at 4%, capped at 4%. So, so it was more of a structural thing. And even of late, recently also, if you look at last 2-3 years, whenever there is some bond which is mispriced, individual comes in big way.
Nilesh, do you believe will access to retail investors help the corporates?
Essentially, what is happening today is that a lot of financial intermediaries are borrowing in the wholesale market and not in the retail market, because the cost of distribution in retail market is very, very high. If I can bring down the cost of distribution, then certainly they could access this retail market as a means to diversify their resource base. The second thing which is probably worth remembering is that today the corporates had easy access to the wholesale funding, but as liquidity has become tighter, they also have realized the importance of kind of diversifying their resource base. So there is a pull as well as push for accessing retail bond market. The proof of this is in the form of some of the perpetual bond which has been issued by various corporates, and this has been easily absorbed into the retail market. Clearly, wholesale markets will have limitations in terms of maturity mismatch, but the retail investors can easily provide 10-year, 20-year and 30-year funding.
So India's debt market compares favorably with the rest of Asia, but more participants are needed to diversify the investor base and reduce funding costs. Jahangir, turning to you, given the market depth of the Indian bond market, do we need foreign investors?
Yes, in the following sense. So if you now look at, what is the depth of the market simply measured in terms of what you can do or what you can't do without a price in the large price actions. The other thing is that who are your buyers and who are your sellers? Sellers, of course, there's only one seller in this case, the government. But in the secondary market, there are many sellers and buyers. But if you look at the sellers and buyers, they all seem to be of the same kind. So they are domestic banks, and they're domestic pension funds and domestic high net worth individuals. And so essentially, you are looking at the same types of buyers and same types of sellers. So what happens then is that if there is a liquidity shock in India, all of them get affected simultaneously and in the same manner, so that there is no real diversity in the kind of shocks that affect the bond market. So the bond market tends to have very sharp gyrations because of that. So what you really need to increase the depth even further is to bring in people who have different kinds of liquidity shocks, i.e. the foreigners.
Jahangir, do you believe that this increases the risk of a sovereign debt crisis in India like Greece and Portugal?
So let's take the question in two parts. I mean, the first question that, it sort of stems from this very entrenched view, not just in the market, but also by policymakers and analysts, that somehow or the other, the capital control system that India currently has, including not allowing foreigners to participate in the debt market, somehow or the other has served India well. But if you look at the actual price that India and Indian policymakers and the Indian financial system had to pay since, let's say, the Lehman crisis, that's been one of the largest in the world. So think about, 2008, the Lehman crisis. On Friday, Lehman announces bankruptcy. On the following Monday, the call money rate in India rises by almost about, 800 basis points. This is one of the largest increases we've seen in the call money rate across Asia and across EM world. In the two subsequent months, October and November, the amount of FX reserves that RBI loses is the second largest among EM countries. The amount of liquidity support and interest rate cuts that the RBI had to bring into play between October of 2008 and March of 2009 is one of the largest among EM countries. The amount of fiscal support, 3.5% of GDP of fiscal support that the government had to bring into play, again, is one of the largest. Not as large as that of China, but pretty much there. So my point is that, we tend to forget that despite all of these capital controls, we really did not get saved. We really had to pay an enormous and a very high price for the shocks that affected India just in the debt crisis. Fast forward to the crisis that takes place when US gets downgraded back in August of 2011, we are still reeling under that shock. And let's not forget the May 22nd tapering scare. So my point is that the existing capital controls that we have haven't really saved India. Your second question was that are we opening ourselves for a debt crisis? Yes and no, in the following sense that yes, there will be a large number of foreign players now who can presumably take the money and run when things worsen. But think about the equity market. In the equity market, we have a substantial presence of foreign players. And if you look at even in the post-May 22nd events, the equity outflow was one of the least. It was much lower than the debt outflows. And one of the reasons was that, there is a reason that, equity players still continue to believe in the fundamental story about India. But, set that aside, one of the other reasons as to why equity funds could not leave India was because they were large. Because any movement on their part, they would actually change equity prices very sharply, and therefore they would have to pay the price. That wasn't the case for the debt funds, because debt funds were very small. They were just about $30-odd billion compared to the $550 billion of outstanding government securities. So they could actually move without paying any price for it. So my point is that if we design a system where we allow foreigners to come into the debt market, there is a natural reason as to why we will not see the kind of flights that we have seen in the past from the debt market. And the question is, how do we design it? Other countries, from Brazil to Mexico to South Africa to Turkey, Indonesia, name it, all have opened up the debt markets. And again, we have seen volatility in the debt market, but again, none of them have been large or destabilizing to the point that these people have turned around and said, look, we really do not want foreigners in our debt market.
And Jesh, what is your view on limits for foreign investors? Should we remove them completely?
I would not say remove all the limits. Remove all the limits, we would be vulnerable, right? I think even if we get, link it as a total outstanding as a percentage, maybe 5, 6, whatever the number one is comfortable, 6, 7, 8, 10. But at least as long as it's less than 10%, it will not be that vulnerable. Yes, and it will bring the depth to the market, and you will get all kind of players. That's where my little hesitation on index fund, getting into index. Index will be, quite volatile because it will move as a herd with the index. But if you improve the limits and get the real money guys, they will actually find value in the curve and not go for the dip. Whereas if you really go for index will actually create a dip in the yield curve for the benchmark stock, which are the index stocks. And that can create some distortion on yield curve. But nevertheless, it will be still better, at least because of index. That's the only way we are thinking that the limits would be freed up. Otherwise, we don't really see limits going to $100 billion kind of situation for government bonds I'm talking about.
And Jahangir, what is your response?
I really think that they should remove all limits on foreign debt. I mean, the benefits coming out of that is that India, which again, as we talked about, has one of the largest debt markets, yet India is not in the global bond index. India has a limit of about 30 or 35 odd billion. Now, if you have a limit on the debt market or foreign participation in the debt market, the only kind of people that you invite or get into the market are typically people who are in the market for short durations. These are people who at the drop of a hat will take the money and run. A large portion of them will probably come into India simply to play the rupee rather than actually participate in the debt market. So what you really want is, the real money, the pension funds, the sticky money, the teachers pension fund in some city in the US. Those are the kind of people you want to come into the debt market. But to get that kind of money, India has to be in some form of global bond index. And you really need to remove those limits that's a necessary condition to get into any of these global bond indices. But once you're in such an index, there is this passive, sticky, long-term money that necessarily has to come into India, and almost exactly the way in which our equity markets function.
Well, unanimous view that restrictions of FIIs need to be reduced. But if removed completely, it will make India more vulnerable to a sovereign debt crisis. Jahangir, turning to you, now as you know, it's really the infrastructure sector where long-term financing is constrained. So what do you think India needs to do there?
Unless they actually resolve these fundamental problems with the corporate debt market, you're not going to get long-term financing coming into the corporate debt market to finance infrastructure. I think if you have different kinds of banks, then banks can play an important role in being, providing project financing. I think that's where, some of the banks can actually be specialized in simply financing projects. And I think so that's a big step. But I really think that on the corporate side, we haven't really addressed the fundamental issues about why corporate financing isn't very long term, that the depth of the secondary market is pretty shallow.
Dinesh, what is your view on why the infrastructure debt funds have not taken off?
Essentially, if we see world over, the infrastructure projects have been either financed from the overseas issuances, like the American railroad companies were financed from European money, or the Japanese infrastructure was partly financed by American money, and so on and so forth. So either we have to open up our infrastructure sector for long-term money from overseas investors, including countries and sovereign funds, or multilateral institutions, or investors who have a long-term money available to them. Now, this obviously carries its own risk in terms of cost and in terms of maturity. The second financing of infrastructure sector worldwide happens from the pension money. In India's case, Government of India is the largest borrower in the debt market, and they take borrowings from 1 year to 30 years. Now, unless until government itself starts borrowing for 50 and 100 years, clearly other infrastructure companies cannot come in that maturity bucket. Today, the benchmark security for the bond market is 10 years. Can government extend its borrowing period and create shift of benchmark security from 10 years to say 15 years or 20 years or 30 years? Automatically, this widens the horizon of investors, and then infrastructure companies also can come to borrow 10 years, 15 years, and 20 years. Today, if GSEC itself is liquid at 10 years, how will infrastructure companies come and borrow 15, 20 year and 30 year paper? The second thing is related to, hedging of your long-term bonds. So technically we have OIS markets and interest rate futures, but both of them are not deep enough, and institutional investors who are looking to invest on a longer term basis, they will extend their duration only when they believe interest rates will fall. Now, interest rates can fall also and can go up also. When they are rising, there is no demand for long-term bonds because you can't hedge your risk. So we need to deepen OIS market as well as interest rate futures market so that people can hedge the risk of long-term bonds. OIS market can be deepened if it is transferred from OTC over the counter to the exchange. That will bring necessary transparency in OIS market. In interest rate futures market, I think we need to introduce cash settlement of interest rate futures, because delivering security every time is not something which is accepted by the market. The other thing is related to liquidity through repo. Now, if I am investing for 30 years and I can hedge my risk in interest rate futures market, I still need to cover my liquidity risk, which should be available through repo market. Now, if corporate bonds can come into CBLO, if it can come into refinance facility from RBI, then definitely I know that I can hedge my liquidity risk either through market or from RBI. This way, your longer duration of the bond market can easily develop.
What is your view about bankruptcy laws in India?
Absolutely. This is part of the security enforcement. Today, we have seen examples where banks and insurance companies and mutual funds, when they have lent money, they are all lending to very high credit borrowers because they are not sure about recovery of their money through enforcement of security from a lower credit. Unless until we can come out with a very, very tight, time-bound judicial process, legal system which allows recovery of your loans in case of bankruptcy, which allows recovery of your money in case you want to enforce the security against the company, this market cannot take off. Somewhere like in US, you have bankruptcy laws, you have chapter protection. Similar kind of models needs to be introduced in India.
What is your view on inflation index bonds in India and when we can actually see them become a reality?
The experience in India about inflation indexed bond has not been very encouraging, primarily because, in the late 90s when it was introduced, it was linked with WPI, and while the WPI index, didn't really kind of match with the real inflation, that's why it didn't become popular with the investors. Globally, inflation index bond is a segment which, is popular in the US and the TIPS, and there are, reasonable liquidity in that sector. I think forget about the international market, just look at the local market. Clearly, domestic investors need an instrument which can give them real return, which can give them tax-efficient return. And the current proposal of CPI-linked inflation index bond meets both those requirements. And I have no doubt in my mind that irrespective of what the international experience is, locally this instrument can become very popular with investors, especially high-tax bracket investors.
Now, Jayesh, as you know, the debt market is already larger than equity market in the mutual fund segment in India as compared to, say, other countries. So why do you think equities are better placed than bonds?
Two things are required. One is tax benefit, and second is the interest rate structure, if it becomes pretty reasonable. I think from that perspective, we can really look at industry size really growing. Of course, it will be a very bold statement to make saying that it should be same as deposit, but yeah, definitely we are nothing right now speaking. If we really look at it, at 600,000 crores, we are really not there.
Jahangir, I can't resist asking you the question on when we can see India included in the JP Morgan bond indices.
Look, I mean, it's going to take I think it's going to take some time. First of all, the government has to have a consensus within themselves as to whether or not they want to enter a global bond index. And then, of course, they have to it's not just a matter of simply removing the limits. That can be done with the scratch of a pen. It's the other things which are far more intrusive and far more difficult to change. And these include, very nitty-gritty things like, the settlement period, domestic custodial arrangements, KYC norms, a whole bunches of these small things. Those also have to be addressed.
Thank you so much to all of you for joining us on the show today. As we've just heard from our expert panel, while the Indian market is deep compared to Asia, we need to do a lot more to improve liquidity, reduce credit risk, improve the interest rate structure, and diversify the investor base so that we can reduce the overall cost of capital for corporates. Our guests have provided many ideas to do that. We're moving in the right direction, but need to move swiftly so that India's growth story does not get compromised by the high cost of capital for infrastructure and the corporate sector. With that, we wrap it up on 6 questions for India with Punita Kumar Sinha. Thank you so much for watching. Next week on 6 questions for India, we raise the question, can shale gas secure India's energy future? With the rising oil import bill impacting the current account deficit, is shale gas the solution for India's energy?